What if the banking system that controls your life today, the loans, the interest rates, the collateral seizures, the wealth concentration, was designed 2,500 years ago in ancient Mesopotamia and hasn't fundamentally changed since? 700 BC, Babylon. Egibi family runs a banking house that accepts deposits, makes loans, transfers money across the empire, finances trade expeditions, and charges 20 to 40% annual interest on loans secured by collateral. When borrowers default, the bank seizes their land, their crops, their slaves, and adds those assets to the family's growing wealth. Fast forward to 539 BC when Persia conquers Babylon. The banking houses don't disappear, they thrive under new management. The Murashu family takes over operations, expands the network of agents across the Persian Empire, writes promissory notes that function as checks, and practices fractional reserve banking by lending out more money than they hold in deposits. Now fast forward to December 2025. You walk into a bank, take out a loan at 24% interest secured by your car or house, and when you default, the bank seizes your collateral and adds it to their balance sheet. Your credit card charges you 21% interest. Your mortgage has your house as collateral. If you can't pay, foreclosure. The mechanisms are identical. The only thing that's changed in 2,500 years is the technology. Clay tablets became paper, became digital entries, but the extraction method is exactly the same. This is the story of how Persian banking houses invented the wealth concentration mechanisms still running the world today. Why interest and collateral create mathematical certainty of wealth transfer from borrowers to lenders. How fractional reserve banking lets banks create money from nothing and charge you interest on it. And why banking has been the most effective wealth extraction tool in human history, because the math always works in the lender's favor. The pattern is clear. Banking didn't evolve over millennia to serve people better. It was perfected 2,500 years ago, and we're still living under the same system. Let's start with how Babylonian and Persian banking actually worked, because understanding the ancient system reveals we're still using it. The Egibi family banking house operated in Babylon from approximately 700 BC through the Persian period after 539 BC. They performed every function a modern bank does. They accepted deposits from merchants and wealthy individuals and paid interest on those deposits. They made loans to farmers, traders, and business ventures, charging interest between 20 and 40% annually depending on risk. They facilitated money transfers across long distances through a network of agents in different cities. They exchanged currencies, since the empire used multiple coinages and trade involved many regions. They financed trade expeditions by providing capital to merchants who would repay with profit after successful ventures, and they held collateral for loans, land, crops, livestock, slaves, business assets, anything of value. When borrowers couldn't repay, the bank seized the collateral. This wasn't occasional, it was systematic. The interest rates were set high enough that a significant percentage of borrowers would inevitably default, especially farmers whose crops failed or merchants whose ventures went wrong. Every default meant wealth transfer from borrower to bank. A farmer borrows money at 30% interest to plant crops. The harvest fails, he can't repay. The bank takes his land, and now the bank owns productive farmland plus still has the lending capital. This is how the Egibi family accumulated massive wealth over generations, not primarily from interest payments, but from collateral seizures that transferred assets from productive people to the banking family. The Murashu family banking house, which operated during the Persian Empire from approximately 5th century BC, refined these mechanisms even further. They developed written promissory notes, essentially checks, that could be transferred between parties as payment. A merchant in Babylon could write a promissory note backed by the Murashu bank, and a trader in Susa would accept it as payment because they trusted the bank would honor it. This created a proto-paper money system where banknotes circulated as currency. Even more significantly, the Murashu bank practiced fractional reserve banking, though they wouldn't have called it that. They held deposits from clients, but lent out far more than they actually held in vault. If the bank held 100 talents in deposits, they might make loans totaling 300 talents, creating money through lending that didn't physically exist. This worked as long as not all depositors demanded their money back simultaneously. a dynamic that still defines banking today and still creates periodic bank runs and financial crises when confidence collapses. The Persian banking system also pioneered the network model. Agents in multiple cities all operating under the same family name, accepting each other's notes, transferring funds through accounting rather than physically moving gold and silver. A merchant could deposit money in Babylon and withdraw it in Persepolis through the Murashu network, exactly like you can deposit money in New York and withdraw it in Los Angeles through your bank's network today. Every mechanism was already in place 2,500 years ago. Here's why the interest and collateral system mathematically guarantees wealth concentration, and why this was understood perfectly well by ancient Persian bankers. When you lend money at compound interest secured by collateral, you create multiple ways to win. Path 1. Borrower repays loan plus interest. You make profit on the interest, your capital returns, and you can lend it again. Path 2. Borrower defaults. You seize collateral worth more than the loan. You now own assets plus you have lending capital back. Path 3. The most lucrative. Borrower makes partial payments. You collect some interest. Then they default and you seize collateral, so you get both interest income and the asset. The system is designed so that borrowers must be productive and successful to repay, while lenders profit regardless of borrower success. If you lend 1,000 silver talents at 30% annual interest, you make 300 talents profit if they repay. If they default, you seize land or assets worth 1,000 talents plus the partial interest they already paid. The mathematics ensure that over time, wealth flows from borrowers to lenders, from productive people who need capital to wealthy people who have capital. This isn't a flaw in the system, it's the design. Persian banking families understood this completely, which is why they passed banking operations through generations and accumulated ever larger estates, land holdings, and wealth. The Egibi family was one of the wealthiest in Babylon, not because they produced anything, but because they positioned themselves as the intermediary between people who needed capital and people who had it, taking a cut through interest and accumulating assets through defaults. The parallel to modern banking is so exact it's almost eerie. Your credit card charges 21 to 24% annual interest, right in the middle of the ancient Persian range. Your mortgage is secured by your house, collateral that gets seized in foreclosure, just like ancient Persian banks seized farmland. Your car loan is secured by your car, repossessed when you default, just like Persian banks seized livestock and equipment. Student loans aren't secured by collateral, but they're not dischargeable in bankruptcy, which makes them even more predatory than ancient Persian loans because at least ancient debtors could theoretically escape through default. Modern banks practice fractional reserve banking legally, holding only about 10% reserves against deposits and lending the rest, creating money through lending exactly like the Murashu Bank did 2,500 years ago. When you deposit $100, the bank can lend out $90 to someone else, who spends it and it gets deposited somewhere. And that bank lends out $81, and so on, until the banking system has created $900 in loans from your original $100 deposit. This is legal, encouraged, and taught in economics classes as normal, but it's the same fractional reserve system that caused periodic crises in ancient Persia when too many depositors demanded their money back, and banks couldn't pay. The 2008 financial crisis happened because banks over-leveraged through fractional reserve lending, couldn't cover their obligations when housing markets collapsed, and required government bailouts to avoid complete failure. This has happened repeatedly throughout history, in ancient Rome, in medieval Italy, in the Netherlands in 1637, in England in 1720, in the United States in 1929, and again in 2008, because the fundamental mathematics of fractional reserve banking create instability. You can't lend out more money than you have and guarantee you can return deposits on demand. The system works until it doesn't, and when it fails, depositors lose money while banks get government bailouts. Here's the empire pattern that connects Persian banking to modern wealth concentration. Banking is the most efficient wealth extraction mechanism ever invented because it uses mathematics to automatically transfer wealth from borrowers to lenders over time. Empires that develop sophisticated banking systems concentrate wealth faster than empires that don't. Ancient Persia had massive wealth inequality, with banking families like the Egibi and Murashu controlling estates, spanning hundreds of hectares, while farmers worked as essentially debt servants. Rome developed banking and saw wealth concentrate into latifundia estates owned by wealthy families, while small farmers lost their land to debt and became urban poor. Medieval Venice and Florence developed banking, and the Medici family became so wealthy they controlled governments. Modern America developed the most sophisticated banking system in history, and we have wealth inequality approaching Roman levels, with the top 1% owning 35% of all wealth, while median households carry credit card debt at 24% interest and mortgages that take 30 years to pay off. The pattern is always the same. Banking concentrates wealth mathematically through interest that compounds for lenders and collateral seizures that transfer assets from debtors to creditors. This isn't capitalism, competition, or free markets. It's mathematical wealth extraction using a system designed 2,500 years ago that works exactly the same way today. When you pay 24% interest on a credit card balance, you're not participating in modern finance. You're experiencing the exact same wealth extraction the Egibi family perfected in Babylon in 700 BC. The interest rate is identical. The mechanism is identical. The result is identical. Your wealth transfers to the lender over time until you either pay off the debt or default and lose your collateral. This is the empire economy, where we decode the systems operating in plain sight but rarely explained honestly. Banking isn't a modern innovation that evolved to serve society better. It's an ancient Persian wealth concentration mechanism that's been running for 2,500 years with only technological updates. The clay tablet promissory note became the paper check, became the digital payment, but the underlying extraction remains unchanged. Lenders make money by lending money, interest compounds wealth upward, collateral seizures transfer assets from poor to rich, and fractional reserve banking creates money from nothing that you pay interest on. Every student loan, every credit card balance, every mortgage is operating on the banking model perfected by Persian families before Rome existed. And just like ancient Persia, the result is mathematical wealth concentration, where banking families accumulate enormous wealth not by producing anything, but by positioning themselves between people who need capital and people who have it, taking their cut through interest and collateral seizures. The system worked perfectly for wealth extraction 2,500 years ago, and it works perfectly for wealth extraction today. Nothing has changed except the technology, and that's not an accident, it's by design.